Dividend payments in the UK. Have you recently launched and incorporated your business? Let's say you are using a limited company to conduct business. If so, this post will assist you by elucidating the dividend concept and the distribution window. The crucial query, what are the dividend tax rates, will also be addressed. A dividend, what is it? A dividend is a sum of money distributed to shareholders from the profits of a limited company. Only a profitable business can distribute dividends. As a result, no payout can exceed the profits made during the prior and current fiscal years. Profit is the amount of money your business has left over after paying all its tax obligations, including corporation tax and VAT, that can be distributed. And, think wages and rent for premises. Dividend payments. Paying dividends is subject to strict legal guidelines. It is illegal to distribute dividends if your company does not have enough post-tax profits to cover the amount. Unlike salaries, dividends are not considered business expenses, which means they are not eligible for corporation tax relief when paid to shareholders. Retained profits and dividend distribution. Your limited company can accumulate profits over several years, referred to as retained profit. Directors are not obligated to distribute profits as dividends at the end of each financial year. Instead, profits can remain in the business and be distributed as dividends in the future. Typically, shareholders receive most of their income in the form of dividends. Depending on individual financial circumstances, this is often one of the most tax-efficient methods of withdrawing money from a business. Steps to issue a dividend. To declare and issue a dividend, you must follow a formal process. 1. Directors meeting. Convene a meeting of the directors to declare the dividend. The meeting must be documented, and the minutes must be retained for legal purposes. 2. Financial review. Print the balance sheet and profit and loss account for the period to confirm that the profits available are sufficient to cover the dividend. 3. Dividend voucher. Provide a dividend voucher for each payment, ensuring recipients and the company retain copies. Each voucher must include the company name, company registration number, names of shareholders receiving dividends, payment date, dividend amount, share class, signature of the authorized officer. Calculating dividend payments. Dividends are recorded in company accounts when they are declared. The payment amounts are typically proportional to each shareholder's percentage of ownership. For example, if 4 shareholders each own 25% of the shares, and the company declares £4,000 in retained profits, each shareholder would receive £1,000. However, exceptions to this proportional distribution exist and may be discussed separately. Important note, if dividends are not correctly documented, they might be treated as a director's loan account. This could result in additional tax liabilities for the company and the individuals involved. Key considerations for dividend payments. It is a common misconception that dividends can be paid from any cash in the business bank account. In reality, a limited company can only distribute its accumulated realized profits, less accumulated realized losses. Moreover, unrealized losses must also be accounted for. Dividends cannot be issued if subsequent losses negate previously recorded profits. Directors are personally liable for any dividends deemed unlawful. Under the Companies Act, shareholders are also required to repay dividends if they knew or should have reasonably known at the time of distribution that the payment was unlawful. The company's Memorandum of Articles, which might contain clauses limiting dividends under circumstances, must also be reviewed. There may be various kinds and classes of shares, which affect voting rights and dividend eligibility. The statement of capital covers information about the company's shares and associated rights. How frequently can dividends be paid out, and when should they be paid? Dividends are usually paid after year-end figures have been agreed upon and there is enough cash. We call these final dividends. However, you can pay dividends if the funds are available. These are interim dividends if a payment is not made at the end of the year. Your company's retained profit and financial performance will determine how many dividends it pays over the year. Each time dividends are declared, A dividend certificate must be issued to each shareholder. The more dividends you pay out, the more paperwork and administrative tasks you must finish. Depending on your level of personal income and the timing of exact tax shifts, how and when you pay dividends may also affect your taxes. Therefore, seeking expert advice regarding profit withdrawal is advisable to comprehend the probable projected tax obligations fully.